The ability for you to build something in today's market has literally, and I mean to the second I am speaking, never been easier, and easier by every second after that. So today we're gonna take a look at one of the big VCs, or a big VC, Sapphire Ventures, and what they have to say about all things AI.
It's true that at least 50% of the pitches that we hear are AI. Every vertical is being touched by both software and AI, but that doesn't mean SaaS is dead. It's sort of why now? What's different? Why does the world need another X? What's the non-AI part of your product? Tackle something that's a new problem area. AI is not alone. AI is not a differentiator.
I love that. Like already, I'm liking what this guy is saying. I hate the idea that your tech infrastructure that everybody is onboarding to, aka like the Web3 craze, I hate that that's your differentiator. It's like, oh, but we're the Web3 version of it. It's like, that doesn't matter. What matters is if you have unique value that you unlock by using Web3 technology, by using AI. Yes, AI makes a lot of things simpler and easier and faster, but there are plenty of ways to do things that don't require AI, that there are paper processes that could be fixed by just having a system. And then above a system, you layer in AI to do fancy stuff. Like, people think you have to go from, no typewriter to supercomputer. It's like, no, there's a lot of steps in this journey, and the right tool for the right job makes all the difference.
Hey, I'm Rajiv Dam. I am a general partner with Sapphire Ventures. Sapphire is a growth stage software, B2B focused software investor. We invest in US, Europe, and Israel. We're managing over $10 billion in capital, partnering with companies like Levan.
Key point: when you are a big, giant, massive VC like this and you're investing $10 billion, the way that you view companies, the types of companies you pursue, the stage of companies that you pursue. Early stage can mean 10 million, can mean 100,000, can mean 100 million, can mean a billion, right? It really depends on the industry. And you take all of that and you realize, okay, what kind of returns does this guy have to get in order to justify having 10 billion in assets? Very large returns. This is not something where he can just have a business go from 0 to 100 million. That's literally a failure to him in probably most cases. He's got to invest in the big boys that get double big, right? Because he knows most of them are going to spend themselves and fail and market issues and whatever, but he has to get that return. And if he's moving 10 billion in assets, how much does he have to move per check? And how much does each check have to grow? Punchline, they're all looking for between 10 and 100 and 1,000x. 10x minimum, 100x ideally, 1,000x if you picked one of the big winners, as it were.
LinkedIn, ExactTarget, DocuSign, Looker, MuleSoft, and more recently companies like Monday.com and Glean.
Yeah, these are giants.
Company. I started my career actually not as an investor, but an investment banker. And I worked for Goldman Sachs, actually in their financial institutions. Investment banking, your primary role is to advise companies on what you think they should be doing in response to a particular situation, whether it be evaluating M&A or going public or raising some financing. That's your job as an investment banker. But
key point here, which he said, your job's to advise. Your job's not to build. Your job's not to do the operations. Your job's not to really know the business. Like, you have to know the industry. You have to know. I covered financial services just like him. I was at Barclays. He's at Goldman Sachs. But it's one of those, just because you're advising on a business doesn't mean you actually understand how to really effectively operate it. Numbers on a page and margins and growth rates and random customer satisfaction surveys don't really show you what this business is, how it works, how it lives, as how it breathes. And I can say that confidently because I've seen both sides. The banker side, where we're doing, billion-dollar capital raises, and the idea stage side, where it's 3 people around a white room going, but what if we, it's like, both sides are very valid, and you can definitely advise on one side, meaning you're an investment banker and you advise large companies and you help them scale. But this is about understanding how much and how little you really know. You may know a lot about certain things as it relates to late stage scaling, but you may be functionally illiterate when it comes to early stage stuff if you haven't really lived it or gotten close with your operators, shadowed, been a person building a business, not just a person watching somebody else build a business while you advise. I learned that in banking. Then I learned that when I first started to do consulting. And then I learned that even more when I started launching ventures with partners. It's like, oh, there's levels of understanding to this thing. And just because you have a lot of money and just because you advise big fancy people, it does not mean you actually know what you're doing at a fundamental level. It means you have a specific subset of knowledge that may be helpful given certain parameters. And that's less sexy for LinkedIn, of course.
Ultimately, even after a couple of years, I realized that instead of advising these companies, what would it feel like to actually invest in them and then help really advise them from the board level, having sort of some skin in the game and chips on the table of investing in companies that you're really excited about. There's a lot of uncertainty, but yet it's exciting because these are growth markets. You're redefining.
When he says the board level and obviously the types of businesses they invest in, it's, you know, they invest in big ones, so they're coming in at the board. That's a very discussion focused support. It's not like you're sitting there sending a million emails on behalf of the company and like co-grinding with them, but you're very much participating in guiding them as like one of a few key voices that they don't even have to listen to really. It's if the entire board votes in a certain way. But this is, again, power dynamics of startups and their boards, startups and their shareholders, startup founders and non-co-founders, startup executives and juniors. Welcome to the battlefield. There's, you know, a lot to win.
We're creating a new market. I feel like I'm a kid in the candy store and learning all the time from entrepreneurs, what they're building, why they're building it, what's on the come. And it's just really exciting to me.
Now that I use Monday service, AI
look, there's Monday right there. You know how much SaaS they're making with all this stuff? And look, now they're expanding.
Helps us manage and automate our
servicing. They're doing ticketing and stuff. Yeah.
And with no code needed. IT, HR, ops, or any other department. Everyone can manage ticketing.
I do love that the Monday commercial is on the guy that invested in Monday. I wonder, they must have planned that.
Every incoming ticket is automatically categorized.
Or probably because the guy mentions Monday in his video, YouTube heard him say it and use that as a reference to then put an ad here, which is probably more likely the analytics behind it.
Strategic stuff, identifying company needs
and opportunities,
so we can finally be proactive.
I want to watch a billionaire tell me how poor I am. Hurry, hurry,
my job doesn't have to be that chaotic. Right, Taylor?
I hope my gray hair looks that good someday. Right now, it's just patchy and vague. All right, back to the learning.
On the market, you want to make sure there's a good market size. Ideally, you want to make sure the company is an emerging, especially at our stage, an emerging leader or a next generation leader. One thing we see is category leaders.
If you're not an emerging leader, that means you're too small. You know, a little translation for you. Emerging leader means you need to be winning the race, because if you win the race, you're going to be the biggest on the block. It's one of those, there can be 100 copycats, but Uber is still giant, right? And Lyft is also giant, but Uber's, you know, double giant, as it were. Because they had that first to market, all that market share, that brand, etc.
Oftentimes, the category leader just sucks the air out of a market because they attract the best employees, they attract the best investors and the most amount of capital. They get the best customers who tell other customers this is the only game in town, and their lead just compounds over time. So we tend to look at not just market size, but positioning with that market. One thing we're looking at recently, given the saturation in the software and SaaS.
When he says market size, just a quick note, it's all relative, right? Because if you own 100% of your business and the market's $1 billion and you make 100 million in it, it's like, well, did you capture a lot? Did you capture a little? Well, if you own 100% of your business, quite a bit. If you own 1%, then nothing at all, right? Similarly, if your business needs to get to be $1 billion for it to be worth his time, that's one thing. If it needs to be a decabillion, a $10 billion plus business, that could also be a problem, right? These are things that you have to navigate and understand, or else when you look at the startup world, you go, the market has to be big. Well, how big is big? Well, it's relative to what the audience really wants to hear. And if you're talking about VCs, they typically want big, giant, massive, enormous markets, depending on, again, are they a dreamer VC, a California VC, or are they like a hard calculating VC that's doing a detailed financial analysis? Imagine if you took like an investment banker. Again, this is kind of a bad example, but an investment banker who just wanted to do the math, not the, the market feel, as it were, because these people, a lot of them are going off of what they need to see happen, how big the market could be, not even how big the market currently is, but where it's going. They're making some really challenging bets.
A space is sort of why now? What's different? Okay, maybe there's a company that has an AI angle and that's going to create some accelerated sort of growth.
Why now is one of the most underrated startup questions because it answers the question, is your timing correct? And a lot of people underestimate the value of timing. And Bill Gross did like a TED talk on this where he ran the numbers and did the analysis. And it turns out timing is like the number one factor that determines startup success. If you nail the market time at the right time, right? You nailed, not just the launch, but the growth of your business. It's not like, oh, we launched in January versus December, we're fucked. Like, it's not it. It's much more of a, as you, in those years of you building your business, is the market going in the right direction? And are you not only leading the market, but riding the biggest wave and, getting that lift upwards? The example, again, imagine you were starting a cannabis business during like the first wave of the cannabis boom. You could do a lot. Healthcare stuff during COVID times, AI during AI times, which we're seeing. Now we're so deep into AI times now that it's kind of getting played out, not in the sense that the tech's done, but we've heard the first wave of the AI this, AI that, AI in my cat, AI in my fridge. Like we've kind of done that part. Now we're starting to get into not only A, taking those things to the next level, but B, going deeper into the funnel of what can be done, this infrastructure side of AI.
Both over the long term, but what else? Is there something inflecting or something changing? I like to say, what's the energy in the market? What is the
he's vibes. He's vibe investing. He's not vibe coding.
Everyone's happy with what they have, and it's going to be hard to go sell new software into it. What is the energy of adopting a new software and companies coming up for renewal in that market, I think is critical. Even if your business is scaling nicely, taking a step back and understanding the context of the broader market, is there an underlying trend or inflection point?
Even if you're worth $10 billion, you're using stock images. I want you guys to know this, to see this. Even if you're a big giant company, as long as you use the right stock images, people don't care and don't notice, right? Not really. I notice because I'm watching startup stuff all the time and always trying to analyze and see what's going on. It's like, look at this. So when people go like, oh, we don't have enough money to make like a high quality, it's like, shut your trap. Will you just look at the things that companies are putting out? Will you Google how to get free video stuff? Will you go to AI and generate it? Like, do the thing, please.
Or a pocket in your competitive space or market space that might be more interesting potentially. And while your company is growing nicely now, there's another company or another pocket of the market that can lead to even higher growth. We call it sort of missing out a little bit on the wave. I think that's critical for some companies, which is incredibly hard to do when your company's performing well and you want to just stick to that lane. But I think it's also important to understand that broader context. And I've seen that multiple times where another company has a slightly different twist or approach, is operating in a slightly different segment or pocket of the market that has more velocity. And you can...
Small distinctions can drive huge valuation differences depending on who you're talking to. I know, for example, there's businesses that I work with that if you change one piece of the underlying product, one of these founders has a 6-figure business and the other has, a 9-figure business, and the other founder I know has an 8-figure business. It's like, you 10x the business because of a little bit of tech underneath. It's like, yeah, because the positioning is a little different, because the way they can say AI or crypto or this or that just works a little different given their audience. And it's also who's setting this valuation. VCs and whatnot, mind you, I love them. They put money in businesses, go VCs. But it's one of those, you're really worth what you're worth to a competitor in my mind. Now, there's reasons they buy you out because they want to like shut you down. But more than that, if they see 10 billion in value in you and willing to pay you, that means there's probably 10 billion more value, 20 billion, 30 billion that they think they can unlock. So even that 10 billion that they gave you, is it fair? Is it not? Whatever, right? But it's much more of a, I value that analysis and that valuation because of what that company sees they can do by acquiring you and using your assets and using your tech and using your customers, et cetera, way more than like an investment banking or like a VC valuation, where it's more about how big can the company get in the market, how big is the customer base, how much of an leader in the market are they. There's a difference where both can come to the same $10 billion valuation, but one is doing it because of what they can get out of the asset. The other is doing it because of what they can get out of the asset, but what, meaning cash versus value. There's a difference.
Kind of take off with the whole prize. One thing I look for a lot, and I talk to customers about, is velocity. What's the velocity of product improvements? What is the velocity of changes that maybe a CEO or a CRO make on the go-to-market team? How quickly are those changes made? How decisive is this management team in making changes?
There's always changes to make, so it doesn't help your case to sit there and agonize over every single one. And small businesses and startups, they don't run like big corporates. We're not setting annual budgets in the same way. Meaning, yes, we may set a target budget for the year, but what if a quarter in something changes, and then 2 weeks after that quarter something changes, then a month after that the market moves? Like, there's a dynamic of change, of evolution, of thinking quick on your feet. Like, you really have to be scrappy at every level in a startup. If you have a CMO that's stuck in their ways and refuses to do anything new, that's not going to work for your startup. The landscape of being a CMO is changing fundamentally. But more than that, in startup land, the way that you think, how much money you have, what's going on in the business, development comes up with a brand new product feature that now you have to reposition certain areas, or maybe the whole business as itself. Like, you have to be okay with change, because until you are a mature business that changes much slower, or you sell the business, change is going to be a part of your business every single day, in the large ways and in the small ways.
This saying, I'm sure someone said it, like, grow fast or die. And I think that's kind of true in startup world. There's something about the compounding nature of sort of growing fast. You almost have to hit that escape velocity.
Respectfully, that's not true. Like, if you're spending a ton of money and you're raising a ton, and you need to kind of keep the energy moving to keep the debtors off your tail, right? It's like, we raised this round, then we did this, then we raised this round, then we did this. Like, if you're living that life, you do have to move quick, because your investors are pushing you from the back, like, go faster, do more. And even though you don't really have to listen to them, if you don't move quick, then the next round, the VCs there or the investors are going to maybe not assign such a value multiple to you. Maybe not, maybe not assume that you've grown as quick or you're worth as much as somebody else. Now, you compare this to more of like a bootstrap startup, where you have all the time in the world. The only thing stopping you is how much time you want to put into the business long term. And also, still, market changes, because you can take 5 years to build something and it makes 20, 50, 100 million a year. You're quite happy. It could also be that year 4 in that, the market changes and it goes to 0. But the truth is, that can happen with VC funded stuff as well. The difference is, when you've raised money from A, B, and C, and they're all like big dog investors, even if your business explodes, because you have, one rung, one failure under your belt, they tend to give you a bit more credit, and then all of a sudden you get to do it again. You compare that to the bootstrap, it looks like he's just, an idiot. It's like, no, this is just someone that took a longer time horizon to build something. And also, depending on how efficient you are at cycling your cash, remember, venture capitalists are banks. They're there to give you money. Some of them can make intros and some of them have guidance, but a lot of them are not. They are there to give you money. So if the bank, how much do you think the bank really knows about your day-to-day business and how you can succeed and how quick you should grow? They don't. They have data historically on what's happened, but data that's looked at historically doesn't mean it's relevant for your situation. Each one of those historic data points had a million unique factors driving it. So it's good to see what happened, but just because it happened there doesn't mean it's 100% applicable to you today. You have to take present market, present situation, who you are, all of these things into account when making these types of decisions and deciding how aggressive you want to be with growth and how much you want to invest. Do you want to raise money? All of these, fundamental questions when it comes to your business.
To make it out as a startup and become some sort of successful company, because if you don't, the sort of laws of gravity of private SaaS just sort of catch up to you, and that's hard. And there's a lot of pressure. There becomes a lot of competition because people see your company growing fast. So
if you're winning, expect competitors, without a doubt.
This velocity of decision making that you do across product and go to market in an organization.
Imagine being able to build anything.
Why?
Just by thinking about it.
Go away.
Base 44.
Come on.
A complete AI creation platform.
Why don't you let me skip?
Made for anyone with an idea and a drive to bring it to life.
Commercials are holding me
Describe what you
hostage.
want
Oh, let's see.
and
Look.
watch it take shape. You can plan, customize, and expand in any direction. From tools built for one to platforms ready for many. From passion projects to enterprise-grade systems. Everything is built in and ready to launch. It's a new world of creation where you can
This is
go
actually
as
very
far
true.
as your
I take it back. This is a decent ad.
Can you imagine it?
The ability
Let's make your
for
dream
you
a
to
reality
build something
right
in
now.
today's market has literally, and I mean to the second I am speaking, never been easier, and easier by every second after that. Because I've seen people that what I would have expected took 6 months in a team get done in 3 months by one guy part-time. And it looks better than some of the stuff I've seen teams build. So this is something, think about what you can really do, because I promise you are 3 months and 100 hours of frustration away from potentially a brand new business, right? Even if it's, you haven't done all the legal and back end and this, that, and the other work, building something and seeing if people want it and seeing if, there's value in it. That's quick today. And that is so incredibly valuable for people that want to build companies, because you're telling me it's easier, cheaper, and faster to build a little version or a mini version of what I want so I can test if people actually want it. And then if I want, I can bootstrap it, or then I can use that momentum to then go raise money and then build, either expand on this or build a real thing. Like, do you not understand? It's like, it's them lending you a shovel to go mine gold. And then the second you mine a little gold, you get to buy your own shovel that works even better. It's like, would you take that deal? It's like, it's a pretty good deal. It's a pretty good deal, especially when the shovel they're lending you is cheap. Like using these AI tools, using ChatGPT, if you added up everything you spend in AI, it's probably cheaper than what you spend on Netflix, HBO, Hulu, and all that other junk. Like, if you're a builder, try and build something. Why not?
What do you do when a potential client says, "We love your product, but it's way too expensive"? Do you give in on discounts right away? Or can you confidently defend your price? Hi, I'm Peter Ahn. With over 15 years of sales experience at companies like Google, Dropbox, and Slack, I've obsessed over how to effectively answer questions like this in a way that builds trust. That's why I created Peter Ahn Sales School with EO to equip startup founders and sales professionals with the modern skills to excel in enterprise B2B sales. This online
I feel like he's talking in slow motion. Is that just me?
Examples and ready-to-use B2B sales frameworks that you can incorporate immediately.
To be honest, I might actually take a look at this.
Pitch deck to authentic customer discovery and even negotiation.
I like his shirt.
I walk through how you could do it all. And limited to just 10 students, I'm also offering one-on-one bespoke feedback on assignments. Ready to learn and grow your sales confidence? Check out the link in the description or find me at EO School.
Is AI
Recent
killing
market
SaaS?
conditions are interesting, is highly saturated with hundreds, if not thousands, I think the latest stat was, of rather large, maybe 30 million to kind of 300 million ARR enterprise software SaaS businesses, from infrastructures to application businesses. There's a plethora of them that are out there in the private markets. Every single category is saturated and also getting funded, by the way, at the very early stages. So if you're a founder tackling something, I would say really push yourself to say, why does the world need another X? Or tackle something that's a new problem area. Tackle something that's, never been done before, or in a vertical that hasn't been touched before. Because, by the way, the other trend I'm seeing is every vertical is being touched by both software and AI now. Ask yourself the why now. Why is this important? Why does the world need another one?
I think what it really comes down to, and a takeaway that I hear from this is, make sure no matter what you're building, that there's a genuinely good reason for building it. It should be that you have an inspiration. It should be that you're a part of your community, right? Or you're a healthcare person that has an idea for healthcare. You're a lawyer that wants to improve lawyering. You're relevant in your space, and it's a problem that you have deep understanding of and deep connection to. Because when that's true, two things become true. One, you can go learn about the market and the competitors and connect with people in a way that nobody else can, because you're authentic to it. The second is you can go do research and understand, hey, if I have this problem X, how would I go solve it? you're your first beta customer, you're your first alpha customer for testing. And you go, well, first I went to this YouTube and then I went to this website and then I saw these solutions and these were the issues that I had. You're doing customer discovery on yourself real time because there's more than likely other people that are like you having the same problems. And it could be that you say, I have this problem, and you go, well, I'm going to go try and solve it. And then guess what? You find the solution and it just works. Well, one, yay, now you solved a problem, but are there problems with that solution? And notice I'm not actually trying to force a problem into the solution. I mean, are there actual problems? There are a surprisingly, frighteningly large amount of apps that you think exist. You intuitively go, oh yeah, this must exist for that. Do not be so certain. Do not be so certain because there's 10 apps in the space, they're any good. Do not be so certain that the people who are running those things have any idea what you're doing. Do not be certain they will be here 6 weeks, much less 6 months or 6 years from now. If there's real problems that have real solutions and there isn't something viable in the market to solve it for you, that is interesting. That's where I get excited as like a founder and someone who advises founders, like, hey, this feels real. I like real because really solving problems is fun anyway. And you find if you really solve a bunch of problems, you really make a lot of money and you really make a lot of change. These are good things.
These companies, because ultimately investors are looking for that as well. What's the difference in this narrative? I mean, it's true that at least 50% of the pitches that we hear are AI already, maybe even 60, 70%. But that doesn't mean SaaS is dead. To me, those are still SaaS companies. AI is not.
Great point. AI doesn't get rid of SaaS. It's it's like Web3 getting rid of SaaS. It's like, no, Web3 is a tech infrastructure and SaaS is software as a service. If someone is using your software and you're getting value in any way from them, SaaS, right? It's just a different wrench. It's like, I'm a mechanic, but I'm using a wrench versus a flathead screwdriver or whatever. It's like, yeah, you're just using a different tool. You're not a brand new person. Now the tool might change what you can do. It might take your SaaS from like a level 1 to a level 5 if you're trying to like scale it in your head, but it's still a SaaS. You're still a mechanic, whether it's go-karts or airplanes, but what the tools you use and the things you can do, very different.
Not alone. AI is not a differentiator. It may use AI as a technology.
I actually really like this VC. Respectfully, a lot of VCs say some wild shit, but this guy's been pretty solid.
That they're leveraging in really creative ways. But like I said, if AI is your full product, there's probably something wrong and we probably won't invest. You have to have an approach, some non-AI technology and integrations.
If your product is something that ChatGPT is going to release as a UI UX feature in the next 6 to 12 months, give up on your business. Like, don't build something that's 1 inch further than the market because then people catch up quick. You have to build in an area of the market that nobody's building or that they are so far behind, or you can get so far ahead, right? Either side, ideally both, right? They're losers and you're a winner. That's where you can make some serious difference. But it's kind of the example I would use is Snapchat can only get so big because Instagram, TikTok, Facebook, and everything else just sucked up all their features. And a feature, unless it's uniquely differentiated and not copyable, can't be a business because as a minimum, the competitors are going to suck up that feature and going to eat into your market share no matter what. Now, I'm not saying Snapchat's a failure, but if you look at where it went public and where this happened and where that happened, I'm sure there are better outcomes that people would have wanted.
Workflows that are different in and around that I think are critical. And so that's what people are looking for. I invested in Monday.com in 2000, maybe 18, 19. What was interesting to me about Monday.com was you had 2 founders in Iran and Roy who really just had incredible conviction in their own direction and vision. Well, one, they presented to me and a group of my colleagues, and it was that night, actually, I booked a red-eye over to Tel Aviv. I flew out there to spend the whole day with them, and they were shocked and surprised. There was a plethora of companies here in Silicon Valley that were attacking the same market with maybe more interesting Silicon Valley logos as customers. But Monday and Roy and Iran just had a different way of doing things. I just saw that they just had true belief in their vision, and it was very well thought out why they would succeed. It was that founder sort of conviction.
It's not just passion alone. And that's, I think, a critical part. And that's VCs will pull up for a variety of reasons, for like building rapport and showing how serious they are. But a lot of it's them doing due diligence, which is them, sussing you out and being like, is this person real? Are they the same at 3 a.m., 3 p.m., and, 9 p.m.? Like, am I going to see different sides to this person that I may not think are appropriate for a founder, or that, aren't conducive to me investing hundreds of millions of dollars, like, in their business? Like, there are all these considerations that need to come in. And as these people pull up, it's great to also do a bit of reverse due diligence. Who have you invested in? What's been your experience? I'd love to meet some of your founders, in your portfolio. It's good to vet it all out. But notice he went through the vision side of like, what do they feel like? But do they have a good tactical plan for execution? All the passion in the world with no ability and no knowledge of how to execute is useless. It's not valuable at all. Passion without execution means nothing. Execution is hollow without passion, but passion without execution may as well not have the passion.
I saw that really left an impression on me that was just really unique in our time together. I think people sometimes don't quite get that. They think growth stage is just very formulaic, everything's sort of working, and you price the company and you try to get money in. There's still a lot that has to work out, even at later stages, and at Monday.com, there was a lot that still had to work out.
Businesses are never done. Until you sell them, they're never done.
About that company and about that meeting that leaves me that energized to sleep 3-4 hours a night for multiple nights. And to me, that's now become a signal. I thought it used to be a flaw. Maybe it still is, but now it's a signal to me. And that happened with Monday, and that happened with many other businesses since. Our business is pretty simple in some ways. It's investing in people you like and you admire that just move you in some way. I think every investor needs to adapt to the entrepreneur and founder.
This is what professional gambling looks like.
If a VC is needing to operate the business, that's not really the entrepreneur that a VC even wants to back in the first place. We want to back an entrepreneur that says, kind of get out of my way. I know what I'm doing here, but hey, can you tell me how much I should compensate this salesperson?
Not all VCs think like this. I like this guy.
3 different distinct go-to-market segments. Are there metrics or KPIs? Can you introduce me to a CTO in your portfolio? Can you sit down with me, talk about usage-based pricing models versus seat-based pricing models and how that's evolving across your portfolio, or what you think, how would you think it applies? Those are the questions that VCs.
Notice it's like advisory, it's consultation. Really, it's not here's how you build.
The business, dictate strategy too deeply themselves. So again, I try to adapt to the company and situation. One thing I've realized from Glean to Monday is an entrepreneur really wants to walk with you similarly as an investor and a potential board member, and just ensure that you really are bought in to their vision.
That reverse due diligence.
Passion and conviction for their companies. I think that's still paramount in terms of winning a deal and figuring out what you want to invest in.
When I talk to my founders, we have a rank order priority. The best money that we want is strategic money, because if someone's investing in us strategically, that means that there's a long-term play. This can be individuals, this could be other businesses, this could be anything but strategic money that unlocks new things, or that is material driver in the business that hooks our boat to somebody else, especially at the later stages. Very helpful. In the early stages, you just need more money. The second version is your financial investors. These are your VCs, your PEs, your whoever. That money comes in. It's always good, but remember, you're dealing with finance people. You're going to get negotiated with pretty hard, right? Just the nature of the beast. And the third is rich, but not annoying. And that's really important. Perfect world, I want someone strategic that adds more value than just the money. Second world, I want like a rich person, or like a VC or an angel, someone that has network, someone that has some skills, someone that I can lean on occasionally, or at a minimum gets the game really well and will kind of leave me alone to do my thing, just as he said. And the third most is, let's say you have your rich buddy that made a bunch of money in crypto, and you have 2 of them, and one is crazy annoying. And if you raised 50K from him, he would ask you questions every single day. The other one you could raise 500K from, and he'd send you a text once a year. Hey, are things looking good? That's the one you raise from. Not because you don't like this guy, but because you need to not be annoyed by the people that gave you money. Imagine if the bank, not like a loan because they have the right to call you, but imagine if like the bank was calling you every couple of weeks with just random thoughts and suggestions for your features and how you do customers. Like, you would lose it. Well, now imagine if it's some random investor that invested 10% into your round, right? It's like, oh God, like I got to listen to this guy. And it's not because you're anti them. You're just pro your business. Remember, they weren't there when you were building. You can take their money and they may have some tips, but it's up to you to really lead this business into the next stage. But overall, I love it. This was actually a really good video. I'm very happy that this guy's a VC and doing his thing. Perfect. We'll see you in the next video. Hopefully this context helped. Peace.